Hello and welcome to Dialogue. The International Monetary Fund, or IMF, is predicting global growth to remain close to 3% for the next half-decade, its lowest medium-term prediction since the 1990s. The comments were made recently at the annual spring meeting of the World Bank and International Monetary Fund, which kicked off this week in Washington, D.C. What more does the IMF say about the global growth? And have the recent banking failures impacted world economy? And how will slower economic growth impact debt relief in low-income countries? To answer these questions and more, I'm joined today by Professor Iain Begg from the London School of Economics and Political Science, Wang Dan, Chief Economist at Hang Seng Bank, China, and Dr. William Li, Chief Economist at the Milken Institute. That's our topic. I'm Xu Jingduo. Welcome to the discussion. IMF Managing Director Georgieva told a press conference on Monday that despite the remarkable resilience of consumer spending in the US, in Europe, despite the uplift from China's reopening, global growth would remain below 3% in 2023. Wang Dan, I will start with you. Is this number, below 3%, the figure you expected?
It is largely consistent with what we had been anticipating, but for developing nations and developing countries, they're facing very different problems, as we can see. And this figure of growth is pretty unprecedented. We have seen that the hiking of interest rates from the major Western central banks have stalled housing market growth and therefore might be dragging the developing nations into a recession. But developing countries might face really high food inflation and energy inflation, also insufficient demand from abroad. So overall, I think this number probably can even be an optimistic estimate of what's going to happen this year.
William, so what's your opinion? Georgieva, the head of IMF, also warned that a sharp slowdown in the world economy last year could linger on this year as well. I mean, how likely is it?
I think it's very likely that slow growth may persist for quite a while because the forces that Wang Dan just outlined are persisting. The inflation seems to be persisting, so interest rates have to remain high, probably for much longer than people think. And also we see that the kind of locomotive effect that China used to have for the rest of the world to pull the rest of the world out of any kind of pending recession is missing this year because much of China's growth has been domestically oriented toward consumers' consumption and also domestic services, which is the right policy for China to have to rebalance its mix. But because of that rebalancing, the world is also missing a lot of the kind of drive that comes from China's growth and China's strong exports. One of the things that we should remember, though, is that going forward, one of the headwinds that face the world is the fact that China's role in the world is changing. It's no longer a place for low value-added manufacturing. It's a place for high value-added manufacturing. And China's new status, I think, is something that the world has yet to adapt to.
But William, one of the drivers of Chinese economic growth is, or at least used to be, export to, in particular, the developed economies. But probably because of the demand, the weakening demand in developed economies. So China's growth itself is, in a sense, like probably there are reasons for them to become slower.
You're absolutely right. The export component of China's growth is highly dependent on demand from the rest of the world. But when demand from the rest of the world is being restricted by monetary policies that are designed to taper down inflation, which is running very, very high in most of the developed countries, that's the dampening factor that will prevent China from having that traditional role of a strong growth driver.
Mm-hmm. Well, Iain, what are the major factors contributing to this rather grim outlook?
How long do you have? The first one is that we're coming out of a period of, or at least we hope we're coming out of a period of stagflation. That's the conjunction of stagnation and inflation. The world as a whole hasn't really faced this since the 1980s. And it's something policymakers find it very hard to deal with because it was triggered by what's called a supply shock. That's to say that the effect of the war in Ukraine and the rise in energy prices that is associated with it caused the rest of the world to suffer. Coming out of that isn't something that's easily done through either monetary policy or fiscal policy, because it's also about terms of trade adjustment. The rest of the world is losing its share of global income relative to the energy producers. Second, there's a long-term trend of productivity. Productivity has slowed across the globe, particularly in the richer Western countries. Third, you have aging. Aging of the population is something which tends to drive down innovation, tends to mean that there's a concentration on services rather than manufacturers. And that shift to services globally is also something to take into account.
Oh, it seems, a lot of challenges. You mentioned about, of course, let's say, Ukraine conflict over there. But it has been a year. Can we say the rest of the world has somehow get used to that kind of situation? Energy shortage or food problems?
Well, to some extent, yes, because there's been adjustments. People are spending on different kinds of goods and services because they recognize not just that inflation is a headline, but also that it can represent shifting relative prices. You will buy the things that are cheaper, and you will cut down on the things that have become more expensive. There's a headline in the British press this morning saying that people are using more Netflix and buying less food. That's a consequence of the relative price changes.
Wow, Wang Dan, so the inflation is affecting at least the people's lifestyle by consuming less, and that will affect, of course, economic growth, right?
Oh, absolutely. Inflation problem has different consequences in different countries. And usually in mid-sized economy that already face economic stress, like Sri Lanka, food inflation often cause social unrest and will have serious political consequences. But in the Western world, particularly in the US, it doesn't seem to have a big impact really on the immediate economic growth. Of course, there's a slowdown in the housing market and economy, but it's mainly because of the rapid hike of interest rates. And in Europe, the stress from inflation is much more severe since it's not energy independent. But for China, as we can see, we do not have inflation problem. Actually, we might even have a deflation problem coming away.
Can you explain a little bit, why China, China is closely linked to the rest of the global economy. The developed economies, they're suffering from high inflation, high interest rate, while China is suffering the deflation.
Mm-hmm. Yeah. Well, to start with, inflation is ultimately a monetary phenomenon, and China has been quite conservative in its monetary easing since COVID had started. And this year, this conservative stance hasn't really changed, especially after the Silicon Valley Bank incident. There is more of a conservative bias in the macroeconomic policy in general, including the monetary policy. And we do anticipate more of a easing stance in the coming month if macroeconomic situations face challenges. But overall, the Chinese government doesn't have that appetite. And in addition, there's also a recovered supply in most of the industrial goods and also food. So we have both higher supply and relatively weak domestic demand, and that's why we don't see the kind of inflationary pressure in China.
Mm-hmm. Well, William, if still like high inflation in the U.S. is not really affecting people's spending habit in terms of consumption. Most of the people would say the high interest rate is affecting the economy or the banking sector, for example. So how bad is it, or can we say it's over with the banking problem?
There's a high level of uncertainty in the U.S. economy right now because it's not clear where the credit crunch is going to be hitting the most. We know that the lending has really dropped dramatically in the last several weeks, but that generally affects about 20% of the U.S. economy because most of the U.S. economy raises money through the capital markets and not the banking system. But the 20% it does affect are small businesses and very labor-intensive businesses, people who hire people. And I think the fear is that we're going to see some layoffs coming about because of the restriction in credit, unless these businesses are able to find alternative sources of lending from banks that are very strong. And as far as the uncertainty goes, I think that is also affecting China. In addition to what Wang Dan said about the monetary influences on inflation, a lot of demand has been curtailed in China because of the huge level of uncertainty regarding unemployment, the housing market, and there's not a lot of fiscal space in China for fiscal policy to push demand. The other thing that feeds the United States strong demand right now is that there's a huge burst of fiscal policy back in the pandemic is still having effect on allowing people to spend well beyond their income. We see their income is slowing down, but the consumption has not slowed as much.
Seems like the prospect of a soft landing is within the reach in the U.S. So are we expecting more interest rate hikes to counter the inflation by the Fed?
There is no question we need to have more interest rate hikes. I think if you look at reference rules like the Taylor rule or things that tell you what traditional monetary policy would need to do in the kind of inflation environment and the full employment environment we have now, those policy rules would tell you we need something north of 6%. And right now the market's pricing in about 5.25%, about 2 or 3 more rate hikes. So I think no matter where you look, more rate hikes are in the pipeline, and the only dampener is the timing of these rate hikes. If the uncertainty regarding the lending and the credit crunch is severe enough, the Fed may pause. But I think they also know that we need close to 6% in order to get inflation back into 2% again.
Mm-hmm. Well, Iain, what about the situation in the European countries in terms of inflation? Are we expecting similar actions by the central banks to cut the interest rate?
The central bank in Europe, the European Central Bank, has been in a very strange position because it's been worried about causing financial instability. We saw Credit Suisse, which is not strictly speaking an EU bank, but still very influential in the EU financial markets, going into great difficulty and being taken over. The muted threats to Deutsche Bank, another big bank. And I think what we're seeing is a transition in monetary policy from what was a period of what we call fiscal dominance. That's to say, the prime consideration in setting interest rates was the risk of fiscal problems in Europe, particularly in the South, to one where there might be something called financial dominance. That's to say that the fear of financial instability is what is driving monetary policy more than the concerns about the indebtedness of the sovereigns. So we're in a strange environment where interest rates are still below the rate of inflation. However, it looks as though inflation may well come down quite quickly. So there's a kind of strange race between trying to avoid raising interest rates too much for financial stability reasons and hoping that enough has been done to curtail inflation and that it will come down quickly and therefore come to the rescue of monetary policy.
Mm-hmm. What about the energy market? In general, the economy. Last winter, a lot of people, or before last winter, a lot of people predicted the difficulties for European countries, but they proved to be okay, actually, with energy supply and with the general economy. What about this year?
Well, I'd say that in that particular war, Vladimir Putin has lost. He hoped to hold Europe to ransom by his actions on gas supply. And what's actually happened is that the Europeans have managed to find alternative sources, including from North Africa, some from LNG from other parts of the world. But also, Europe is accelerating its shift to alternative energy supplies, particularly green energy supplies. So we're in a tricky moment. But I would expect that in the next year or two, the trends for European energy supply are going to be much more positive, and the dependence on Russia will slowly evaporate.
Mm-hmm. Another problem pointed out by the IMF and it seems to be the FDI fragmentation, Wang Dan. Here, I quote the statement from a warning from this monetary fund. Said that FDI flows from advanced European countries to China declined by 19.7 percentage points, almost 20%, and to the rest of Asia by 9.8 percentage points, almost 10%, while increasing to the US by 7.5 percentage points. How do you explain this, the increase to the US and decrease to China and Asia as large?
A simple answer to that is the US sanction or the export ban to China has been working. It has scared away many global investors from further investing in China. But it's not just a European phenomenon. Even for Chinese companies, now a rising trend is also that domestic companies are trying to outsource more work to broader Asia, to the US, to European countries in order to circumvent the potential tariffs or potential future sanctions related with high energy sector, high tech sector. So it is a reality that all the corporate world that have to face very seriously. And we have to understand that the reallocation of the supply chain is inevitable since it's getting more expensive to produce in China. But now it seems that the push factor is not as important as the pull factor, which is the geopolitical cost. As long as the US China relations cannot improve from where we're standing now, then there will be more of a fragmentation of FDI in the future.
But what about the other factor? For example, China being the largest market in a sense with 1.4 billion people. Understandably, it is critically important to some of the companies or manufacturers because China, the market, produces like more than half of their profits globally. For example, German, the automobile makers here in China.
Oh, absolutely. And that's why there are two parallel strategies for almost any multinational corporations. So they have to, on the one hand, be in China for China, produce for China, investing in China. It's sort of this enclosed investment and consumer market within China. But at the same time, they have to diversify the production to other countries in order to lower the tariffs and the political cost. But we can also see that for certain companies, for example, Apple or Tesla, their production is so integrated deeply with the Chinese supply chain, and it's such a long supply chain. It's not easy to be relocated elsewhere. So for them, it's quite hard to move away. But for many of the smaller producers or the intermediate industrial goods producers, it is relatively easy for them to make new investment elsewhere. And that's in a way inevitable.
William, obviously, because of the tension between China and the U.S., as Wang Dan said, we are seeing like a global supply chain or is being reshaped, sort of away from China. But where do they go? Do they go to the U.S. or do they go to Asian countries or Mexico?
Well, this is actually a very important part of the economic picture. And this is what I meant earlier when I said China is really transforming itself to from low value added manufacturing to high value added manufacturing. It's keeping the Apples and Teslas in because it is a huge consumer of Apple and Tesla products. And as Wang Dan said, companies are realizing that the strategy of if you're in China, you're producing for China, you're investing in China. And the shift to India and other parts of Asia of the low manufacturing, like to Vietnam, is part of this financial fragmentation that you talked about. But it's really, as you just said, a shifting of the global supply chains. And I think one of the things that you noted earlier was that the U.S. is receiving a more FDI because the U.S. is trying to develop its own manufacturing base to regionalize its supply chains as opposed to having more stretched out supply chains that we see with globalization, chapter 1. I think the IMF has pointed out that the financial fragmentation may be harmful, but also it may be beneficial because, as Iain said, productivity is enormously low right now. We need productive investments to be able to raise productivity. And this is an opportunity for a lot of these companies to raise the level of productivity by shifting their manufacturing base and by modernizing their manufacturing base.
Well, Iain, we know that European leaders like French President Macron and the European Commission President Wang Dan just left China. They talked about the Ukraine issue, but also bilateral issue, for example, investment and trade. Anything positive in terms of more trade and more investment in each other?
I think it's for the future rather than for the immediate. There are hopes, particularly from Emmanuel Macron, that things can be regularized in the relationship between the Western countries and China. But there's always the pressure coming from the US to be very suspicious of China. The expressions that have come out recently include the one called friend shoring. That's to say that you invest in the country that you are friendly with rather than the one which maybe has the most economical offer to give you. We talked previously about onshoring, bringing activity back, but friendshoring seems to be being encouraged by the US as part of its foreign policy. Also, I think we've not mentioned it yet, but the Inflation Reduction Act in the US is a big incentive for companies to move to the US. We've seen examples of European companies going to the US for just this reason. They may well have anticipated it in the data that we've seen previously because we could see it was going to be coming. And the trend from Obama through Trump into Biden's administration has been to prioritize US manufacturing in a way which is going to encourage it. And the Inflation Reduction Act is only the latest episode of that trend.
Speak of this, reshaping of a global supply chain, Wang Dan. There are reports, at least occasionally, you do see Chinese companies themselves like moving to East Asian countries or South Asian countries or even Mexico. And then they produce and manufacture and then export it to the US. So maybe the impact on the overall economy of China, yes, there is clear impact, but for the individual companies, not as much as it seems to be?
Well, for individual companies, if they have a global ambition, then they would consider to move at least part of the production to Europe or the US, at least closer to its markets. But most of the high-tech sector in China are not specifically in a good position to be produced abroad, because for the corporate world, any cost is cost. Geopolitical cost is a cost, transportation cost is a cost, and the custom clearing in different sovereign nations is also a cost. Once you move something out, you do need to weigh the pros and cons and whether it makes sense. And the geopolitical cost right now is quite high when it comes to, say, the electronics supply chain, or some of the high-tech products, or clothing or toys that cannot escape high tariffs. But for majority of the goods, it's way cheaper to produce in China, even when we account for the higher political tensions. So I don't think there is necessarily a need to move a lot of the supply chain out of China, but in order to prevent any escalation in a bilateral relationship, it's just a necessary step to do.
Well, despite this dark prediction by IMF, Georgieva pointed to India and China, saying that Asia's emerging markets are expected to see a substantial rise in economic output, with India and China predicted to account for half of all growth. So, Wang Dan, again, what is making Asia fare better, say, than the rest of the world?
Asian economy are quite resilient in that they are quite integrated in its manufacturing capacity, centering around China, of course. And the rise of China and India as major consumer markets and the manufacturing center are quite important. So now we're eventually in this state that Asia is almost comparable to the European continent in terms of the consumer capacity or the future economic prospect. But now a lot of people are worried that the bilateral relation between China and the US can put a damper on the global investors' appetite to invest in the region. But as long as we have the technological advancement and also the automation process in manufacturing, then I don't think that the decoupling in manufacturing can really happen.
Well, Iain, the IMF and the World Bank also called on wealthier countries to help plug a $1.6 billion hole in a concessional lending facility for low-income countries. We know that they are suffering from higher borrowing costs in US dollars and also decline in demand for their exports. So they are facing basically, pressure, two kinds of pressures, which could even lead to poverty or more hunger in these countries. What can healthier, wealthier nations do, or are they willing to do to help them out of a crisis?
Well, this is a perennial question because 1.6 billion, the figure you give, is insignificant in the scale of these things. The lending facilities for the countries in difficulty would easily swamp, the lending requirements of these countries would easily swamp that kind of figure. So there's a moral question for the richer countries. Are you willing to do more to support the poorer ones? And in this context, the richer countries do include China because of all the loans it's put out through the Belt and Road Initiative. So there is an imperative for the rest of the world not to lose sight of the damage that could be done by tightening of monetary policy, by restrictions on imports to the countries which aspire to enter the global supply chain. And here, once again, we need to be aware of those parts of Asia and those parts of Africa which are not really frequently mentioned in this regard.
William, what happens if the richer nations, let's say in this case, including China, they refuse to do the necessary, or they say they have their own problem if they are unable to do the necessary?
Well, the problem with aid to the poorer countries is what form of aid. Iain hinted at it in that if we give more loans to these countries to tide them over, it just burdens them more with high interest payments later on. And so the question is, are rich countries willing to give grants, outright grants to these countries in order to tide them over these difficult times? And I think the history has shown that grants themselves are not successful unless they're tied to development. The countries are able to improve their infrastructure, their human capital, their ability to produce, so that in the future they can actually earn the income that's needed to pay off these high debt burdens. And right now, that kind of aid has not shown to be successful. And I think the IMF and World Bank are doing some very deep thinking in terms of how to restructure the type of aid in order to incentivize productivity, incentivize education, incentivize raising countries out of poverty in a permanent basis, and not by loans that burden them even more in the future.
Well, Wang Dan, countries in the developing world, obviously they suffer from, people would say, debt problem, but they do need money. They do need loans, more loans from World Bank and other financial institutions, or even independent countries. But more loans to solve the debt problem?
Well, maybe they need a different type of creditors. In history, very few countries receiving the IMF loans say good things about it. People in general dislike IMF because there's usually very strong conditions attached. And those policies are usually counterproductive when it comes to relieving their economic stress. And because they need to lower interest rate usually. And it's not a good time to restructure the domestic economy. But usually IMF would require something like that, or raising the tax rate. But other countries, including China, might provide an alternative. So that's a different creditor structure. I think the world should consider seriously about it.
Well, with that, we come to the end for today's show. Many thanks to our guests. You can also find us on the CGTN app on YouTube. I'm Xu Qinduo. Thank you for being with us. See you next time.